Most cup and handle patterns traders point to aren't actually cup and handle patterns. They're sloppy bases with a handle drawn in the wrong place. The textbook pattern, properly structured, has one of the highest historical win rates of any continuation pattern. Sloppy versions of the pattern fail at rates close to random. Today, the four structural rules that separate a real cup and handle from a hopeful drawing, the volume profile that confirms the pattern, and the entry trigger that turns the setup into a high conviction trade. Here are the four rules. 1. Cup depth should be no more than 30% below the prior high. A 50% or deeper retracement is no longer a cup. It's a major reversal that may or may not recover. 2. The cup should be U-shaped, rounded, with no sharp V at the bottom. A V bottom signals panic, not orderly consolidation, and the pattern usually fails. 3. The handle should form in the upper third of the cup and drift down slightly, 5 to 15% retrace at most. Handles that dip into the lower half are bases that broke, they're not setting up the pattern. 4. Volume should dry up during the handle and expand sharply on the breakout. Without the volume profile, the breakout has no participants and usually fails. Watch this in a synthetic chart. A trader sees what looks like a cup and handle and waits to buy the breakout. The cup is 50% deep, too deep for a real continuation pattern. The handle is in the lower half of the cup, wrong location. Volume is messy throughout, no clear dry up or expansion. The breakout attempt fails within 3 bars and price drops to the cup low. None of the four rules were satisfied. The pattern was wishful thinking. Real cup and handles look different and behave differently. Here's the single most diagnostic rule. Volume must dry up during the handle. As the handle forms, daily volume should drop below the recent average, visible on the volume bars as a clear contraction. This dry up signals that sellers have exhausted and buyers are quietly accumulating. Then on the breakout, volume must expand sharply, well above the 20-day average, ideally double or more, confirming real participation in the move. Dry up plus expansion is the volume signature that separates the textbook pattern from a base that happens to look like one. Without that signature, skip the trade. Now the textbook pattern. Cup depth 20%, well within the rule. U-shape, rounded, no V-bottom. Handle in the upper third drifting down 5%. Volume clearly contracting through the handle, then expanding sharply on the breakout candle. All four rules satisfied. The trader enters on the breakout with volume confirming, sets a stop below the handle low, targets a measured move equal the cup depth. This is the cup and handle that famous traders are talking about, the version that historically returns the high win rates, not the sloppy lookalikes that fail. On a real chart, scroll back and apply the four-rule test to every cup and handle you can find. You'll find that most fail at least one rule, usually the depth or the handle location. The few that pass all four are responsible for almost every famous cup and handle trade you've seen. Quality patterns are rare, and that's why they work. Stop forcing the label onto every consolidation. Wait for the textbook version, and your win rate on the pattern will change dramatically. So, a real cup and handle has a shallow rounded cup, a handle in the upper third with declining volume, and a breakout on expanding volume. Miss any one rule and it's a sloppy base, not the pattern. Wait for the textbook version. They're rare, but they're the ones that work. Subscribe for the full method and trade your own plan. Education, not financial advice.